So let's talk about risk, which is the second building block. What is risk? Because I think it's important to ask that question. You might think, oh, obvious answer what risk is. I don't think it is so obvious. So think about this for a second. How many think, if you had to pick one of these, okay? Look them over real quick. What is risk? The potential to lose money. How many think it's the potential to lose money? Okay? How many think it's the potential to lose time? How many, no matter what I say, you're not going to raise your hand? How about the potential to lose out on your goals? Okay, you think that's what risk is? Interesting. What I want to suggest to you today, it's all three things. All three of those. That's what risk is. You see, risk in itself is not a bad thing. And I would suggest that right now, with the market, let's see, after today's loss off around 11 or 12% since November, I wouldn't really say that's risk. Now, if it keeps falling, and it does it for a period of time, and you start adding the loss of time, and then it starts affecting your goals, that's serious risk. Okay? That turns into risk. But it is time, value, and goals, and that's what makes up risk. You know, risk is a very simple equation. And you got to look at it from the standpoint of you have kind of a baseline, okay? And that baseline is if you put your money in a CD, you're not taking any risk, right? You're not taking any risk at all. They're going to pay you like a 4.5% return. It's a risk-free return. You put your money in a money market. Pretty safe stuff, right? And so anytime, this is the way you got to look at risk. Anytime you go a little bit above what's considered safe, okay? And if you're trying to earn what's above the safe level, that's taking risk. Well, see, what's a really interesting thing is that you heard about these money market accounts and these short-term bond funds that have lost money. Have you heard about this story? Because of all these subprime mortgages, okay? So what these money managers did, they said, we want to try to get a little bit more. We want to get a little bit more. They took the risk, and it was the ultimate risk because a lot of these funds lost a ton of money. So here's the deal. If you can afford to earn 4.5% to 5%, okay, you can afford to do that, and that gets you to your goal, why take risk? Doesn't make any sense to take risk. Well, if you're like me and you have millions of bucks sitting in the bank, and you got to make your money work harder for you, you got to use risk. You got to use risk to make your money work harder, and that's why it's extremely, extremely important. You see, there's a downside to risk, and it's simply this. This is what I think a lot of people don't realize, is that if you do have a big loss, how long it takes for you to recover from it. How much return that you have to have. And look at this chart, this next chart. You know, if you lose 10% in your investments, you know, like today, I would say probably most stock market investors are probably down about 10% or so from, or no, probably a little more than that, from the highs in November. And it's going to take you about 11% to get back. That's very doable. But as you start to go down the chain here, if you lose 50% of your money, if you had $100 and went down to 50, you've got to make 50 bucks, 100%, to get back. And you know what's interesting? And I actually, I had to double take them, and I had to recalculate these numbers because this couldn't be right. But if these numbers are right, if you lose 60%, it takes 150% return. How long do you think it's going to take you to make 150% on your money? What if you lost 70%? How long is it going to take you to make 233%? You think risk is important? It's extremely important. Let me tell you about a guy named Bill. Bill loves to fish. You can tell about Bill. Bill wants to retire. He wanted to retire at age 65. He did all his gold planning. He was very heavily invested in stocks. He was doing great. Got to 65. Year 2000. He had to have $1 million put back. Okay? He achieved it. In 2000, he said, I'm going to retire. So he retires. Unfortunately, unbeknownst to Bill, he was about to retire during one of the worst periods of the stock market was going to go through and experience for a number of decades. But in 2000, of course, we saw the market start to go down. Well, at the end of 2000, his $1 million turned into $881,000. Bill wasn't too concerned because he was still drinking the Kool-Aid and, believed that everything was going to be okay. And then 9/11 happened in 2001, and his account sunk down to $766,000. And so you know how you feel when you get to that point. You go, oh, it's got to turn around, right? Well, unfortunately, it didn't for Bill, because then in 2002, his account that was $1 million, he was set for retirement. He was right where he needed to be, but he was a stock market investor. He ended up at $587,000. You see, Bill took the ultimate risk. What's the ultimate risk? Time, value, and goals.